There's so much media attention on the debt ceiling itself and the possibility of default because they can't roll their debt properly, and they might even have a higher chance of defaulting on the earlier loan. And so that's kind of another problem.
Like a dark storm gathering on the horizon, Lynn Alden's foreboding voice pierces the silence, warning of an impending debt ceiling dilemma that looms over the world with the weight of impending doom.
What I'm kind of focused on is what happens after the debt ceiling, because if they do successfully raise it, the Treasury's already depleted their cash balance. They're nearly at zero. They don't really have any spare cash anymore, and so they have to go back to the debt market like they normally used to and issue more bonds in order to keep paying their bills.
With each passing day, the debt ceiling dilemma tightens its grip on the fragile threads of the global economy, threatening to unleash an avalanche of financial chaos that will shake the very foundations of our existence.
The Treasury General Account started drawing down more quickly at that point, and you actually, measures of domestic liquidity started trending sideways rather than down throughout quarter four, and that kind of coincided with the dollar index coming off of its highs, the market coming off of its bottom. Treasury market liquidity still wasn't great, but it was no longer as bad as it was.
As the clock ticks relentlessly towards the precipice, Alden's words resonate with haunting clarity, painting a grim portrait of a world teetering on the edge, held hostage by the impending debt ceiling crisis that will plunge nations into an abyss of uncertainty and despair.
That's also why most countries don't have a debt ceiling, because it's like almost a separate thing versus the actual spending authorizations, which are done by that country's political body, whether it's a Congress or Parliament or however they tend to operate.
In the corridors of power where illusions of stability are spun like gossamer threads, Alden's unwavering voice stands as a beacon of truth, exposing the fragility of the system and the dire consequences of a debt ceiling dilemma left unaddressed.
So the challenge there is if they do that too quickly, or they do it with a lot of longer duration bonds, they risk pulling that liquidity out of the banking sector. And they risk causing another round of bank liquidity problems, failures, messy treasury auctions, messy treasury market, illiquid treasury market in general.
Against the backdrop of political posturing and partisan bickering, Alden's resolute warnings cut through the noise, highlighting the urgent need for action to avert the catastrophic consequences of a breached debt ceiling that will send shockwaves through the global financial landscape.
If they draw it down to roughly zero, down to the hour during the debt ceiling, and then they want to refill it, that's $500 billion that wants to get sucked out of the market into this liquidity void. And so, it's smaller than reverse repos, but it is a meaningful percentage of it. And especially when there's already liquidity issues in the system, it's certainly a meaningful variable.
Amidst the sea of indifference and complacency, Alden's words echo like a chilling prophecy, revealing the interconnectedness of nations and the looming catastrophe that awaits if the debt ceiling dilemma is mishandled, plunging us into the depths of an economic abyss.
So going forward, I think it's largely unchanged. These proposed spending cuts are basically token around the margins. They can affect individuals that happen to be in the crosshairs of those, but in a macro scale, these are not very significant spending changes. And so the long-term path towards large ongoing structural fiscal deficits is basically unchanged. There's so much media attention on the debt ceiling itself and the possibility of default, which is, of course, it's a newsworthy event. It's also it's really good for clicks and things like that. From a macro perspective, beyond whatever last minute deal or technical default or whatever they do, for me the question is, once they get it resolved, what is the next steps for liquidity? So to answer your other question, if you go back, ever since early 2022, the Federal Reserve has been doing quantitative tightening, where they're reducing their balance sheet, and then they're also separately raising rates. And so they're trying to tighten monetary conditions. If we look at the quantitative tightening, what that means is that they let some of their existing bonds mature, and then rather than reinvest those as they would, they just don't reinvest those, which means that as the Treasury needs to reissue them, some other buyer has to come in and buy them. And so the Federal Reserve is basically slowly destroying base money and reducing their holdings of mortgage-backed securities and treasuries, which means those securities have to be absorbed by other participants in the market. It's very similar to if they were to sell them, with some minor technical differences, because they don't realize a loss or anything like that. They just let them mature. So part of the reason why the first half of 2022 was so bad for most asset prices was that liquidity was constantly going down, because you had the Fed was no longer adding liquidity to the market, and back then the Treasury was refilling its cash account from roughly zero after the prior debt ceiling issue. And so that was a particularly bad combination for liquidity, and we could repeat that again, but it's going to come down to what a handful of policymakers decide to do. How quickly do they want to fill that? What duration do they want to fill that? Are they going to be able to pull it out of reverse repos, which would be somewhat liquidity neutral, or are they going to end up kind of messing it up and pulling it out of banks and causing a round of problems? In 2008, because it happened in housing, is the biggest loan area, right? That was a more kind of existential crisis among even the big banks. Whereas in this environment, obviously the duration and interest rate mismatch has been a problem. But in terms of credit, I'm less concerned about overall credit contagion, while still being concerned about pockets of bad credit. So like in auto lending, banks that are very exposed to that, as well as commercial real estate. And even in commercial real estate, it's like you have to kind of segment by type, right? So office space versus real estate for a restaurant are two very different types of commercial real estate. And so, for example, some of the travel spaces, some of the warehouse spaces, some of the restaurant spaces, like that kind of stuff is generally doing pretty well. Whereas like office spaces and certain other types of real estate are the ones that are really suffering. And then even across the board, even if a property itself is marginal, if the valuations were very high when it was kind of financed with low interest rate debt, as more and more of that matures and comes due, that causes problems, and then that cascade into defaults because they can't roll their debt properly, and they might even have a higher chance of defaulting on the earlier loan. And so that's kind of another problem that the small and medium banks face. In addition to having raised rates to keep deposits, they also have that higher overall exposure to commercial real estate. So I think that's one of the areas of the economy to be concerned about, and it slows things down, causes problems, while other parts are either immune from it or benefit from it. Because if liquidity and rates have trouble tightening due to problems in those sectors, it allows other sectors that are not harmed by some of those problems to keep carrying on. When we look at the inflationary decades over the past century, most people think of the 1970s, but that was really driven by demographics and bank lending more so than fiscal. Whereas the 1940s were more driven by fiscal and not really driven at all by bank lending. And so far in the 2020s, the inflation we've seen has been due to large monetized fiscal deficits, whereas bank lending levels have been normal. And so I think that this is an ongoing inflationary backdrop, which can then, to varying degrees, be offset by monetary tightening, contractions in credit, things like that. We'll see what magnitude they want to push it, but this is kind of a key source of inflation. And a final point I'll make is that when we go forward, we look over the next 6 months or so, a challenge is that this raising of the debt ceiling can actually be negative for market liquidity depending on how they handle it. And what I mean by that is if you look over the past 6+ months, the Federal Reserve has continued doing quantitative tightening, but during that time frame, the Treasury was offsetting a lot of the Federal Reserve's tightening. They were actually pouring money into the economy because they had previously built up a very large cash balance, and they had to bring it down to their normal baseline, which is about $500 billion. But then due to the debt ceiling, they had to bring it down to almost zero. And so actually they were kind of pushing excess liquidity into the market, kind of against their will, and that actually offset quite a bit of the Fed tightening. And so the challenge going forward is that if the Treasury were to refill their cash accounts or even just hold it low, they're no longer depleting it because it's already depleted. You could also see kind of forced QE while still trying to hold rates tight. One of the dynamics that we saw back in 2019 was the repo spike. And back then, you basically had a flood of T-bills come to market And there wasn't really a lot of excess bank reserves to kind of pull that out. And so you started to get dysfunctions between bank lending. And so the Federal Reserve had to abruptly stop their quantitative tightening and go to doing quantitative easing, although they didn't want to call it that because they were only doing with T-bills, and they were only doing it for financial stability rather than as an intended form of stimulus. So the reasons for it and the specifics were a little bit different, but basically they kind of lost control of their balance sheet temporarily due to actions by just overall liquidity and treasury decisions. This one would be a little bit different because it's not that there's too many T-bills, it's that there might be too many T-notes and T-bonds relative to cash to absorb it, relative to the money wants to stay in money markets, and so I think you could see a similar dynamic. It's also kind of what happened back in March with the first round of bank problems, is that the Fed didn't want to provide that liquidity, but they were kind of forced to temporarily. They had to open up this new facility and use a bunch of existing facilities to put at least temporary liquidity back into the market. And so you could see the Fed's hand forced if they were to break something seriously, like if the treasury market gets dysfunctional, if you have another round of bank failures, if some of those kind of key markets freeze up again. I often bring up the 1940s, and that's really what they find themselves in. So if we go back to the 1970s, the inflation that was happening was a couple key reasons. One is you had the highest ever rate of U.S. bank lending, and that was in large part because the baby boomer generation was entering their home buying years. So you had most of the money creation was from bank lending. Then number two, that was exacerbated by there were larger fiscal deficits. Now, they were actually a smaller component of money creation than bank lending, but they were still adding fuel to the fire. And of course, you had oil issues, right? So domestic oil production peaked in 1970 after literally going up for 100 years. And then as it started to go flat to down, we became more reliant on imports. And then obviously we ran into geopolitical issues in the Middle East, where we got cut out of the market for periods of time. And so the combination of supply side limitations, but then also record demand for loans, really it caused a lot of money creation and inflation. And generally the tool that central banks have to deal with that is a tight policy, especially because debts as a percentage of GDP, both public and private, were very low back then. And so they could radically tighten monetary policy, get to really positive real yields, discourage a lot of types of borrowing, put the economy into kind of a controlled recession. They basically crushed Latin America. I mean, basically they had all this dollar-denominated debt. The dollar spiked, and Latin America had a lost decade, and that basically took demand out of the global market, so that basically United States could have more of it. So it's kind of like throwing one person under the bus to keep yourself afloat. That's the policy they could go with. The 1940s were a different environment, which is that the money creation was almost entirely from fiscal spending. There was no excessive bank lending. Banks were barely lending at all in the 1940s. And yet that decade was just as inflationary as the 70s, because obviously you had massive monetized fiscal deficits to fight the war. I think the first half of 2022 is instructive there. So the market kind of peaked. Many markets peaked in late 2021, around that time frame. And if you look at that chart you have in your screen, the Treasury general account went from basically empty. So the blue line went from basically empty, and then it shot up to nearly $1 trillion. And that was while the Fed balance sheet was basically flat. It was topping out. If we have a similar environment where the Treasury general account tries to go up while the Fed balance sheet is going down, you might have a similar negative dynamic that we saw for the first half of 2022 in terms of asset prices. Now, I don't think it'll be maybe the same magnitude, because going from 0 to $1 trillion TGA is unusual. Their target is about $500 billion. I think there might have been geopolitical decisions were made in that. I think they were kind of purposely trying to strengthen the dollar and kind of crush oil prices and things like that. So I think that some of those things are aside, but I think that's kind of the overall framework we have when looking at the combination of Federal Reserve either no longer loosening or outright tightening as they are now, combined with the Treasury also tightening. So that first half of 2022 is kind of the danger scenario. And we have to see to what extent things start to look like that in terms of these liquidity dynamics, or if they deviate, if they're able to suck liquidity out of the reverse repos, then maybe we can avoid that scenario. But I think when it comes to setting expectations or identifying risks ahead, that's kind of the key thing to watch. This is mostly a 6 to 12 month story because this is specifically trying to refill the treasury account from an unusually low level, which really only it gets down to this level due to debt ceiling issues. And we're also kind of skipping along kind of the minimum amount of liquidity that the banks can have. We kind of ran into that level back in March around the bank crisis. Specifically, the small and medium banks were kind of at their liquidity limit, and they got refilled a little bit because these temporary Fed actions. But if we do another environment where the Treasury's now sucking liquidity back out, the Fed's still doing quantitative tightening, we could retest those liquidity limits and kind of get another round of this. So when we look longer term, it's different types of fundamentals that I would look towards, but liquidity is what I look towards when I'm trying to figure out what's going to happen in 3, 6, 12 months, or at least it's a big factor that I consider among some others.